Hello, how's everybody doing? Getting ready for another fun-filled night of entries and exits. We're going to do something a little different tonight. We're going to look at different ways to scale into high time frame trades and look at the possibility of reducing our risk. And if by reducing our risk to kind of look at what might happen, are we more likely to, are we able to reduce where our stop is and maybe keep our risks lower so that we hit one-to-one faster? So those are some of the things we're going to look at tonight. And quickly, I'm going to explain to you. I investigated three methods. So as price comes into a band of interest and you set the trade, waiting and getting into, you get a candle that matches the direction that you want price to go. So if you are shorting, you would want to see a red candle, and then you would get in after a red candle was printed. Then looking at using bases, again, if you're shorting, you would want to see that the base would break lower, leaving the base high in control. Then to look for band confluence. Sometimes on a higher time frame, you will see a really beautiful demand or supply band, and you will, as you look at lower time frames, you will see a band on the lower time frame that's also in the higher time frame band. And so we're going to look at a couple examples of that. And then we're also going to look at what happens if a new band is created once price enters into the high time frame band. And as long as it's created before price moves away one-to-one from the original high time frame band, what would that band look like, and how do those perform? So that's kind of where I'm going tonight. Any questions about that? Let me get the chat open. Might help so I can see the questions. All right. So let me show you. So first of all, a little background. I decided to do this on a stock instead of a future. And what I did was I used our back testing functionality in the tool to determine what was the best time frame for achieving one-to-one with a band. And so you can see here, I've got a 377-minute band, and the raw band success rate hitting one-to-one was only 28%. Weekly was 33%. 144-minute was 40.151%. The 610 was 45.7. The daily was 44.93. So those are pretty close. And then the monthly was 100%. But in this scenario, there were only 4 bands, and we don't make decisions based on only 4 bands. We always want to have at least 30 data points. So I chose to go with the 610 minute. So that's how I chose the time frame that we're using. Get rid of that. So let me start out. What I did was I've got the 610, and then I went from 610 down 4 fib numbers. So from 610, there's 377, 144, and 89. So I started with 55-minute. Then I looked at 34-minute, 21-minute, and 13 minutes. So those were how I looked, the time frames I used for scaling in. So if we look at the traditional method, Here's our band here. And you can see that price pretty quickly came back into this band. And then it printed this green candle right here. And I made the wicks thick so you could see that that came all the way down to here. So in this scenario, if we used the green candle and put our stop at the bottom of the wick of the green candle, in this scenario, getting in, basically you would, once the green candle printed, you would set your market order at the open of the next candle. And in this scenario, you really don't save yourself anything because your original stop was your 260.11. So you're not, let's see, is this the exact, let's see, let me make sure. Let me put this call sheet. So you can see this is not actually. So this candle here, the low was 260.24 and the low for the band is 260.11. So it looks, it's a little deceiving with the way the graphics are on TradeStation, but let me just show you here. This band, see this little bit of blue here? If this band had been totally violated, this would all be red, and actually these lines would be pink instead of gray based on how I've got things set up. So price never hit the original stop if you were doing this as a traditional trade. And if you were setting your stop at the end of the wick, once the green candle printed, and you got in at the open of the next candle, you would have stayed in the trade. And I only tracked this until we made 1-to-1 of the original high time frame band, because once you make 1-to-1, you know, you're in a free trade setup if you're trading 2 contracts. So I didn't track it any further. So does anyone have questions about that? Let me look at the chat. Okay, so the next method that we were looking at is to have a base, and this is our basing candle, and you can see it's got a little yellow mark on here to, the indicator tells us it's the basing candle. And so price broke higher right here. And then at that point, you would actually get in the trade at the open of the next candle. And you can see here that you had a little bit of a gap up. And that's because if you look here, this was the end of the day candle. And this was the start, the first candle printed at the opening of the regular trading hours. So you would have gotten in here. And as you can see, if you put your stop right here at the bottom of the base candle right here, you would have been fine, and you would have reduced your risk quite a bit because this would have been your stop. And then it would have gone on and made 1-to-1 for the entire band with no heat. Okay. Now, because this is the high time frame band, there is no confluence here because I don't that's only with the lower time frame band, and no band was created in the high time frame scenario. So, you know, you could have been in a situation where, you know, price came back in, created a band, and then you take the retest. But I did not see that occur as I was looking at these different scenarios. So do you have any questions about that piece? All right, if not, I'm going to move on. And just so you know, real quick, I do have all this, I recorded all this in an Excel sheet. So here's the long trade. I recorded the results for the 6-10-minute time frame using the green candle and the broken base. And then I do the same thing for the green candle, the broken base, the band confluence, and the new band creation for the other time frame. So I do have all this data here. So just want to show you guys that. And we'll go over that in more detail at the end. Okay, so next we're going to go to the 55-minute. And what I did was I put my fibs on here to show where the original band was on the higher time frame. And then I looked, what I had to do is it gets a little confusing sometimes when you're going from the higher time frame to the lower time frame. So I put a line here. This is the 1600 candle on 9/22 was the leg out candle in the higher time frame, because it can be a little confusing when you do this, because you'll start looking at it and you'll think that price has already retraced back in, but this was the prior action coming into basing and coming out of the band. So this was, this was not a valid entry right here. We couldn't have a valid entry until price came in right here. So everybody clear on that piece? Okay, looks like we are good on that. So price came in, and you can see here that we printed a green candle. So we would have gotten in the trade here at the open of the next candle. And if you put your stop below the green candle, the bottom of the green candle, you can see that you would have been fine and you would have never been stopped out. Let me move this out of our way here. So now you're going to see something a little bit interesting here when we start looking at the bases. You can see here that we actually had a base drawn right here, and price actually opened up outside of the base but closed inside. So I would probably not normally treat this as the base to be broken for entry. I actually use the upper one here just because this is a little bit of an anomaly, and I don't like to play with anomalies. Any questions about how that ended up looking that way? Okay, so let me go back down. So this base right here is the base, and actually let me make that just a tad bigger so you can see. So you can see this is the candle that started the base. So when price closed higher here, we would have gotten in at the open of this candle. Now, if we had put the stop at the low of the base that started the candle, you can see in this scenario, we would have been stopped out. So if you left your stop in the original location for the higher time frame, you would not have been stopped out. But interestingly enough, because of the way price exited here, you would have actually ended up with more risk. Actually, let me get this slide out of the way. It's an old line. So when price closed above here and you got in the trade at the open of this candle, you would have actually incurred additional risk if you were using your original stop. So that's a part to consider. All right, let me take this back down. Now, we did not have any confluence bands on the 55-minute because this is actually, this here is a supply band and we would be looking for a demand band. So there was no pre-existing demand band and there was no new demand band created. So that's all we're going to do with the 55-minute. Any questions before we shift over to the next time frame? Okay. So now we're going to go to the 34-minute. Okay. So here you can see on the 34-minute, make this just a tad bigger here. This was the first green candle printed. And so you would have gotten in. Let me show you this here. Let me move my data window back over here so you can see this real quick. So this candle right here was the close at 1600. And this was the open the next morning. So when this candle closed, if you set a market order here, you would have set your market order here and you would have put your stop here. And in this scenario, well, actually, no, I lied. Rewind. So this is the candle and you would be putting your stop below here, but price actually opened lower. So in this scenario, you would probably want to put your stop below this candle. And this is where you need to kind of look at your rules and decide what makes sense for you and for the scenario. And one of the reasons I did this on a stock was to show you guys some of the issues that you have to consider when you start looking at the gaps that happened at the market open. So hopefully this gives you a few things to think about as you think about like how you would scale in, and obviously you're going to have to set your own trade plan rules for how you want to handle these scenarios. But if you had put your stop below here, obviously you would have been stopped out because you would have opened market down here. So just something to consider. So now let's look at the first base that's broken higher. So this candle right here, we broke higher on this candle right here. So then we would actually be getting in at the open of this candle right here. And you can see that this candle here was the maximum heat you took after you got into the trade, and you would have your low was 261.22. So you would have saved yourself a little bit of risk in this scenario, and it would have worked out fine. And you can see here, price went on and bet your 1-to-1. And so we don't have any new bands created that were demand bands, and we don't have any prior confluence bands. So that is all we have to review for the 34-minute. Any questions on the 34-minute before we move on to the next time frame? Okay, so let's look at the 21-minute here. Oop, I got to get to the right spot. That's where these lines really help. Okay, so Here's our original leg out. Here's the high time frame band. And look at this. Happy day. We have confluence with a lower time frame band. So let me show you this. So you can see that this, if I can get this. So this band here was actually created just before the leg out on the higher time frame. And you can see here by the coloring that price came back into this band and used up most of it, but not all of it. So that was a positive trade there. So, and then price went on to meet your 1-to-1. So let me get back over here where you can see what's going on. So that's an example of the confluence band. So let's get back here. And you can see right here, we had our first, let me blow this up a little bit. So price came in, we had our first green candle here. We would have gotten in at the open of this next candle, and price did come down, and it came all the way down here to um, 261.22. So if you had put your stop below the green candle, you would have been stopped out immediately on the next candle. And if you had done the original, kept your original stop, you would have been fine there. So that's where, depending on the time frame and depending on the, sometimes the asset and the time of day that price enters into the band, especially not so much on the stocks and the ETFs because of their reduced trading hours. But if you're looking at this for futures or even Forex, there's times a day when the volume is lighter, and that can obviously work for you or against you. So then we look for the first band that breaks higher. And again, we've got this unusual band here where price opens out here. So I looked at this band, this base right here, and it actually happens to coincide with a band that was created on the, as price was moving out of the test of the band. So that was kind of an interesting coincidence there. So if you're looking at just the base, when price broke here higher, then you would get in at the open of this candle here with your stop at the bottom of the candle that started the base. And you can see here that you hit a low of 263.79 and the low was 263.80. So in this scenario, you would have gotten stopped out using the drawing it based on just this first candle. But if you look here, the band it created because it put the distal down here at the bottom of this wick, this band did work and result in a good trade that didn't get stopped out. So you could have put your stop here and had quite a bit less risk. So that's an example of the band being, because you can see, let me just make sure this is clear to you guys. This is the original leg out. Price came back in, and as price was leaving, it created this demand band, which it came back and retested. Now, as I have looked at this on some different charts and stuff, I have seen a lot of times where these bands will be created and they will never, price will never retrace to them. So, if that's your strategy, know that there is a chance you will not get filled. All right. Any questions on the 21-minute chart? Okay. So let's go to the 13-minute chart. Okay. So here price comes in, you print your first green candle right here. Seems like I'm always making things a little bigger. So you print your first green candle here. And if you got in here and you had your stop below the green candle, you would have been stopped out. But you would have been all right if you kept your original stop. So then you look at the base, the first base that breaks higher, and it's this base right here. And again, price breaks up higher. You would get in at the open of this candle right here. And you can see price retrace back to here. That's the most heat you took. And so you would have been fine with having your stop here, and it would have reduced your risk a little bit. Not a whole lot, but a little bit. So then we also had a confluence band here. And it, if I can. So this was the leg in. This was the leg out on the higher time frame. You can see that it did create this band here. And when price came back, it actually, this is the one where it gapped through it the day before. So let me maybe make sure you understand the timing of all this. Let me blow this up a little bit. So this candle right here is your 1600 candle. And this candle right here is the first candle of the day. So what happened was when the market opened, it opened below this band. So you wouldn't have taken, or I wouldn't have taken this band because price opened below it. And that's where, you have to decide what your rules are. Some people might have, set an entry as price left the band, even though it gapped through it. And obviously, if you did that, it would have been a good result. So that's a confluence band. Now, so here's our first green candle on this time frame. If you would have gotten in here, I need to make those bigger. But if you had your stop right here, you can see you would have been stopped out on this candle right here. Kind of the whole concept of printing a green candle and putting your stop at the bottom of it, I'm not seeing performs very favorably. And that's just on the cues. if you have something that's maybe a little less volatile, it might work out as a viable strategy. That's just something you got to test on the market you trade. All right. So then price, here's your 1-to-1 line up here. So price came out of the band back into it, and we did create 2 new demand bands. But as you can see here, these are blue. So price has never come back in, touch these. So these are fresh bands. And this is an example of them getting created and price never making it back. So that's taking you through the time frames. And so kind of what I did here, let me make this a little bigger for you. So you guys can see it good. So anything that's pink would result in a stop out with the modified risk. So, the typical trade would be putting your stop at the distal or the distal plus some wiggle room, whatever your trade strategy is. Then the candle would be the green candle method would be putting it at the bottom of the first green candle. And so, and then the broken base would be putting it below the candle that started the base. You could also, if you wanted to, when you look at, the base, you could say, okay, well, this is the candle that started the base right here. And if you're looking at it, and of course, this is this base broke lower, but in the scenario, if you had the wicks of these candles exceed the top of your base, you could set your stop there, and that might give you some more wiggle room and keep you in trades. And again, it's just something you got to look at with the different markets. Any questions about that before I finish going through this? All right, you guys are a quiet crowd. You must like to hear me talk. Then you have the band confluence, which you can see the first time we saw that was on the 21-minute. And that would be your modified stop there would be putting your stop at the distal of the confluence band. And then with the new band being formed here, you would also modify your stop to be at the distal of the new band. So those are looking at the modified stops. So as you can see here, on the 6-10 time frame, you're not your stop modifications, your risk was lower, a little lower for the green candle, but it was actually more for the broken base because of where you got into the price. So that's another thing you have to consider when you start to look at if you're going to use, a candle in the direction of your trade or a base breaking in the direction of your trade. You could be in a scenario where that puts you in a more risk situation, and that may make you uncomfortable. So, but then you can also, modify your stop. So the broken base in the 55-minute was a stop out. The broken base in the 34-minute was a stop out. The green candle in the 21-minute was a stop out, as well as the broken base. But the low of the base, the lowest wick in the base did hold. It actually got stopped out to the tick. And then the green candle got stopped out for the 13-minute, and the band confluence got stopped out. If you had had that trade set up in advance and price gap through it in the morning, if you did not take it until the market opened, then you probably wouldn't be in the trade unless you took it as a stop limit as it came out. So that's kind of the results of looking at a long entry. So then I decided to look at a short entry, but I wanted to look at one where there was like a kind of a lot of chopping around before price actually came out of the band. And so that's these results. So let me show you what that looks like. Hello, talk to me. Where's my band? All right. So this was a short trade, and here's the original band. And you can see that price kept getting near the band, but not quite entering it. And it did finally enter the band. Let me get this out of the way. And it did chop around in here a bit before it finally decided to come out on the high time frame and meet 1-to-1. So I wanted to see how, looking at the different types of strategy methods, how that worked. So if we look at the first of all, since it's high time frame, there's no confluence. And you can see here that price came in, printed a red candle. You would have gotten in at the open of the next candle. And if you put your stop here, well, you put your stop right here at the top of this red candle, you would have gotten stopped out probably by this candle, definitely that candle. So, so that did not perform well. But if you left your original stop, you were fine. Then if you look at this as base breaking lower, price broke below the base, created this candle, and you would have gotten in at the open of this candle, and price would have traveled through and broken the high of the original base, and you would have stopped out in that scenario. And there's, because it's the higher time frame, there was no confluence. And as you can see here, let me show you if I can move this over. We did create this band here, but it's actually a demand. It's actually a drop base rally. It's not a supply band. And so we did not get any supply bands before we hit 1-to-1. So now let's go look at the next time frame. Oop, didn't mean to do that. Okay. Sometimes TradeStation does this. If you go up to window, you can, when it won't give you the little thing to close the window, if you go up to window, come down here, then you can pick the chart you want, and then it a lot of times will fix itself, but not always. So just an extra little trick for you tonight. All right. So you can see here on the 55-minute, we did have a confluence band here that had the same stop as the original band. And you can see that these are our markers for the leg out bands on the higher time frame. And we will go over here. And you will, oop. And this is where price enters. So let me. So you've got your first red candle. Okay, first red candle here. Get in at the open of this candle with your stop up here at the wick, and you can see you would have gotten stopped out with the red candle method. So then the next thing is to look for the base breaking lower. And so you can see here that you had a base that broke lower. And that was at, let's see, 10:05. And then the next candle was 11 o'clock. So once this broke lower, you opened here. So if you got in here, you would have quickly gotten stopped out. Then price did create a new band, a supply band right here. And what happened here is this is 1600 was the leg out. The next morning, it opened above the band. So similar to the other scenario we saw. So we probably would not have traded that. But if you got in here, if you didn't, if you just decided to take it as a stop limit, let's see, how would that have turned out? I think it would have stopped you out. So not a good result there. But this is the confluence band, and you can see your risk would have been reduced tremendously because you've got this just tiny little band here. Price came wicked into it and moved away nicely. You did create another supply band here. Price came back in, tested it, and moved away nicely. And you created another supply band here. And this was at the end of the day, and price opened up above it. So wouldn't have been a trade you have taken. So you would have had a couple opportunities to potentially get in. And with the minimal risk, if you took every opportunity that seemed viable, which really it's only this one, it would have ended up with a good result. And let's see, did it hit that one? Price, like I said, this is a good example. So price came back in. It never quite touched this little supply band right here, but it did wick to exactly the top of it. So that would have been a stop out. So if you were trying to add on there. And then eventually price did gap down here and you hit your 1-to-1. And so we stopped tracking it at that point. So 55-minute was pretty interesting. Had a lot of things going on there. A couple opportunities to get in. So let me. Whoop. Guess we're going to go back up to the window again. So now that was, let's go look at the 34 minute. Okay. Let me show you. We also have a confluence band on this one. All right. So you can see here, this was your leg in on the high time frame. This was your leg it out. And again, you got another confluence band on the 34 minute here. And you can quickly see that price did come into that band. It did not penetrate it or stop out. Let's see if I can move this up a little bit before hitting 1-to-1. So that worked very nicely. So let's look at the red candle. So here's your first red candle printed. You would get in at this candle, and with your stop above here, you would see that you would pretty quickly get stopped out. So let's look at if you have a base break lower, again, putting your stop above here. You've got a high of 191.73, and this would eventually have gotten stopped out right here. So the base would not have worked in this scenario either. So then you're looking for, we've got we looked at the confluence supply band. Now we got to look at what happens with the supply bands that are created after price moves in. Let me just blow this up right here. So we've got a base drop here. Price comes back up in to the band. And this was toward the end of the day at 15.18. And it broke the band. So this band would not have worked well. Interestingly enough, it created another band. And again, that band also got stopped out if you were using the distal of the smaller band. And then here, we had another supply band that got created. And again, would have stopped out. But the original confluence band, when it hit it, price moved away nicely. So I can see the 1-to-1. And you can see price came down here and hit the 1-to-1 from there. This band, supply band right here that was created, was not hit before price made it to 1-to-1. And let's see here. Do I have that? I don't think I have any other. I guess this was a base drop here, which would have been a stop out if you use this as your stop. And in this scenario, this is a good one to talk about because you can see here, you've got your drop base drop, and you're actually past the entry point. So you could use this as your stop, but if you use the original stop of the high time frame band, you're greatly increasing your risk. So you'd have to decide what your trade rules are. You may only want to take a band that actually occurs within the original high time frame band when price enters in. So lots of things to consider. All right, so I still don't have my thing. So annoying. Okay, let's go to the 21-minute. Okay, on the 21-minute again, we have a confluence band. Show you that real quick. So you can see here. So looks like if you see these bands on multiple time frames, that's something to get pretty excited about, and that could definitely help reduce your risk. Of course, obviously, if this is where you're setting your entry, there's a probability that you might it might not ever make it there. You might not get filled. But so let's go and look at our different options here. Okay. So let's look at our first red candle. So this is our first red candle. We would get in at the open here, stop above. You can see we would end up getting stopped out with the red candle method. So if we look at the break of the base, again, you will see that price will go above that and stop you out. And so price, here's an example where price kind of straddled the band and created the entry and created a drop-based drop. And you can see here, price came back in. This was at 1600. So it gapped right through it and created a stop out. But I mean, if you look here, if you see how big this is. So 198.98. So it's 32 cents, which is a lot smaller band than $4.90. So, you could look at it and see if these work for you, for your asset and your interval. You may have little losses, but then end up with a big profit. It's just something you gotta test. Really, I'm just trying to give you guys, show you the different options and get you to thinking about how to look at price action. And, it's, higher time frame bands can perform really well, but they can also make you anxious by how much they get penetrated. And so if you can make yourself comfortable with figuring out how you want to scale in, that could go a long way to allowing you to, use those high time frame bands. And you can always, do some things with options, because, if you buy an option, you're only risking what you paid, right? Or you could do some kind of, debit spread or something to reduce your risk, or even a credit spread. All that depends on volatility and all that good stuff. to make sure you're getting a good setup. So let's see here. And then you had another, so you got this supply band, which price gap through. And then you did go up here, you hit your original confluence band. You created another supply band here, which price never got back to before it hit 1-to-1. Or did it? Yeah, it did get it. It did hit it. Let me scrunch this down a little bit. So you have this band here. Price did come up, wick into it. And then let me make this go away. That's going to confuse us. So this was an example of a supply band that was formed that did end up with a good result. And then this one here, this base drop here, price went right through that. And let's see, was that no, it wasn't. I didn't know if it was a market open, but it wasn't. So price gapped right through that one. And then, let's see. And then price wicked through this one as well. And this one never got hit before price got to 1-to-1. And then here's another example of a band that was formed right at just past or just below your entry. And you can see price marched right through that. All right, so now let's go look at the 13-minute. Any questions while I'm switching over? Okay. So again, here, red candle, price would have stopped out with the red candle. Price would have stopped out with the base. You did get a band created here. Price stopped out there. You did not have a confluence band on the 13-minute. You did create several supply bands while price bounced around in here. But you can see you encountered quite a few stop outs, and we're quickly running out of time. We only got 4 minutes left. But this band right here that was created, price hit it, and it did hold. And let's see. I'm not sure if this one got retested before we made 1-to-1 or not. No, and this one, this band right here got retested before we hit 1-to-1. So, so as you can see, sometimes those newly formed bands on the lower time frames are kind of a mixed result. So I don't have a strong opinion, but I don't have enough data points yet. So quick summary of the short trade with the choppiness. You can see the typical trade on the high time frame worked fine, but the red candle and the broken base failed on the 610, and as well as the 55-minute and the 34-minute and the 21-minute and the 13-minute. The band confluence on the 55-minute was good, as well as the 34-minute and the 21-minute, but the newly formed bands all failed. The first, and I just looked at the first newly formed band. I did not look at the subsequent ones, just for clarification. So that is a quick review of different ways to scale into a higher time frame trade. If you guys have any questions, you can put them in the chat, or or you can post them in the blog in the Foundry, or put them on the YouTube channel, whatever your preference is. If you have ideas for what you would like to see for the next few entries and exit sessions, please let us know. Trying to not make this the Lisa show, but to provide you guys with opportunities that will, and just things to think about to help you refine your trade plans. So next week, we might look at using a certain profit target as an exit and see how that works for us. So you guys have a great rest of your evening.